Welcome back to another episode of Gimme Some Truth. Clint and Alicia and myself, Nate, are in the booth today to talk about salt, not Himalayan pink salt, which is, I think, the best salt, actually, from a cooking standpoint.
Agreed.
What is your favorite cooking salt? Let's start there.
I like the giant sea salt flakes,
Okay.
the Malden salt that you put over
yeah.
the steak and it
Yep.
just melts in
That
after
one?
you get that. That's my favorite.
We're also not talking about the Salt Shed, a fantastic music venue in Chicago. Alicia, favorite act at the Salt Shed?
Well, you and I were both there, Cold War kids.
Oh,
That's actually
fantastic.
the only show that I've seen at Salt Shed, but I'd like to go back.
So good. No, we're not talking about that. We are talking about the tax-related acronym called SALT and why it was so popular in the last 12 months. You almost couldn't pick up a headline referring to tax without seeing the word SALT in it. So, Alicia, what is it and why does it matter?
SALT stands for state and local taxes. So that includes things like your property taxes. It can include sales tax, or it includes the payroll deduction tax that your state deducts to pay for state taxes. And previous to the One Big Beautiful Bill, the limit on those taxes that you could deduct on your return was $10,000 if you itemized your deductions. But this summer, that was changed to $40,000. So the cap is now much higher, which means a lot more people are going to end up itemizing their deductions again instead of taking the standard deduction. Even though the standard deduction is still pretty high, the SALT cap being raised for people who pay a lot in property taxes and higher income earners, they might end up itemizing again.
Or higher charitable deduction people.
Yeah, so itemized deductions are not just state and local taxes,
Yep.
but having a 40K cap to start with, then you add on mortgage interest on top of that, charitable contributions on top of that.
Yep.
For some people, medical expenses, depending on if you're paying a ton of medical expenses, but all of those things are things that can be included in your itemized deductions.
Clint, why did this change?
Well, it's legislation, so One Big Beautiful Bill changed all of it. The cap was only 10,000 prior to that, and now it's up to 40. So, it's a situation that's going to ensnare in a positive way a lot more people in there. So the standard deduction is now the only way, and you really do need to have somebody give you a hand with and figure out which direction you're going to take, and you do have to make some proactive steps before the end of the year.
Yeah, absolutely. Alicia, we were talking before the record button was pressed as to who it affects, right? And I think that it's easy to kind of gloss over who it may affect to just assume, well, it's just this very small slice of people within the population, but that's actually not true.
Yeah, a lot of people underestimate sort of how much they pay in state and local taxes. Property tax bills in Madison, it's pretty easy to get over $10,000 alone just on your property tax bill. And then for higher income earners, anybody above 200, 250, they're probably paying a good amount in state taxes as well. And if you have a mortgage and you're paying mortgage interest, it can add up pretty quickly. And then suddenly your itemized deductions are more than the standard deduction. And even if you're sort of on the line, there's a strategy that you can do, a couple different strategies to basically clump all of those expenses into 1 year. So you're itemizing in 1 year and then taking the standard deduction in the next year and then itemizing again the year after that. Because you do have some control over when you pay your property taxes, when you make charitable contributions, things like that.
Yeah, and we figured out more or less January 1, 2030, right? So, I mean, you have 4 years starting today, if you will, going into 2026 to kind of have these strategies take hold.
Yeah, so it's up through the 2029 tax year. So starting this year in 2025, 25, 26, 27, 28, 29, you have 5 tax years.
Tax years, right.
In which to do it. And if you alternate those years and plan out which years you're going to pay your property taxes, because your bill shows up in December, you can pay it all in December, or you can pay it in January, or part of it in January, part of it in July. And same with like quarterly estimated payments. People have some control over that last payment. Is it December or January? So you do have some say of which tax year you're actually paying those things in.
Yeah. Other things like 401k contributions and things like that can have an effect from a strategic standpoint.
Yeah, I mean, dealing with income and everything. And there's some issues with, as your income goes up, and Alicia will go through those in a moment, but as your income goes up, you lose some of the ability to have this work in your favor. So you've got to plan that out a bit. In some years where you're going to take the deduction, you may want to, make sure that you're making those big 401k contributions in there to make sure you stay under certain benchmarks. And you're absolutely right, Alicia, when you say like, you've got to strategize. And one thing I would encourage people to look into is if you have your property taxes that are in escrow, sometimes they kind of just automatically send the check at a certain time. So you got to work with your escrow company if you're going to end up doing this. Like mine gets sent in kind of automatically at the end of the year, before the end of the year, because that's what I've had before. And if you don't have that worked out with the escrow company and you want to lump these in all in one year, you might accidentally pay it when you don't want to.
Yeah, I think that's a great point. Absolutely. Let's play out a scenario. Household, 2 incomes, $250,000 of income in the household. Maybe what are the top 2 or 3 things that they need to be thinking about as of now? I mean, we're in November of 2025, right? So now, and then maybe we're not quite have enough time this year, but yet 2026 as well. I mean, what should they be thinking about?
Really, it's do we have enough for this to make sense, right?
Sure.
Look at how much you pay in mortgage interest, how much your property taxes are, how much you're each paid in state taxes. You can look at last year's return and get a lot of those numbers. And if you're sort of on the fence, if the standard deduction is, it's a little over 31,000, and if you add up those numbers and you're getting close to that, suddenly if you pay 2 years worth of property taxes in 1 year, well, now it really makes sense. And now you're going quite over that standard deduction amount. And so then, it requires a little bit of math, a little bit of, research, but I think that can be really impactful.
Because you could make 2 years of charitable contributions at one time as well. Probably want to let the charities know that that's what you're doing, but you could do that as well to basically double up on that.
Or start a donor advised fund.
Sure.
If you want to spread those contributions out, charities like to get donations regularly. So if you don't like the idea of only giving in alternate years, put the money into a donor advised fund in the year that you're itemizing, and then you can still give to charities consistently, but then you get the deduction all in one tax year.
Great time too when we have highly appreciated securities and a lot of taxable accounts. So the people that have those positions in Apple, NVIDIA, and all your Mag 7 that have done very well, a good opportunity to shift those over to a donor advised fund as well.
Yeah, absolutely. Let's wrap up on this. That's a great advice for kind of the average listener. What do we do in our office if somebody were to come in? We're going to get tax returns. We're going to analyze the tax returns. Returns from the last couple of years, and that's going to give us a ton of guidance.
Yeah, and like one of the first things I look at is if we think their AGI is going to be over 500. Which good for them, right? Or sometimes people have like a big event where they're selling a business or getting some equity compensation and that's pushing their income up. If your income is over 500K, you actually start to phase back out of that 400 or 40K cap. So if your AGI is over 500, you start to phase back down to a $10,000 SALT cap. It makes your effective tax rate between 500 and 600K be actually 45.5%. Because you start to phase out of that increased SALT cap so quickly. So people who are close to that may look at additional ways they can defer income, whether that's pre-tax 401k contributions, maybe you have access to a deferred compensation plan, or you have some control over your income, any way that you can defer tax to maybe keep it under 500. And then the next year, if you're going to take the standard deduction, then maybe you go a little bit higher that year. So there's a lot of strategies that you can look at. And it sort of depends on who's your employer, how much control do you have over your income. But those are some of the first questions that I start asking.
I think it's like a lot of things in the world of finance. If we're not proactive, we kind of get whatever the reactive solution is, right? And I think for a lot of people, that's maybe not the best solution.
Yeah, and you really have to watch the things that people don't really track during the year. So, right now, for the last like 12 months, we've gotten pretty good interest income out of our bank accounts. So that is going to end up showing up on your tax forms. So if you're holding a lot of cash, all of a sudden that shows up there. You've got some dividend incomes that you could be getting from investments as well for the ETFs that you hold or stocks that you hold. And then whatever your advisor or you've done yourself for capital gains and losses, including crypto. So any of those that you've been kind of trading alongside, not really realizing that, that could be ending up on your tax return that you weren't even aware of. And then all of a sudden your income explodes or you don't end up being eligible for the new SALT cap. You get phased out because you just all of a sudden did something. And so you got to look at it now. You really do. If you got to take this seriously, you need to take a look at it, run your numbers, and make sure that you're taking advantage of it as much as you can, because this is real money that you could be leaving on the table.
Yeah, and that's why it's important to talk about it now, because there are some things you can still do before the end of the year. Yeah. Where if we get to tax time and you're giving your accountant or tax preparer all of your documents, there's really nothing you can do at that point to reduce your income or to do the timing of some of these things. So planning ahead, and your accountant may or may not be reaching out to you, being like, hey, this is something you should be worried about. If you wait until it's tax time to do this, you're going to be left with not a lot of options.
Or things you shouldn't do. Like, you shouldn't recognize that capital gain. You shouldn't do it on December 27th. Maybe you should wait until January 3rd and kind of roll the dice a little bit on that. Or being able to get that donor advised fund either in or started really soon in the previous, in the next year. So there's definitely some things that you should do or shouldn't do between now and the end of the year.
Well, and if you want to open up something like a donor advised fund, please don't do that on December 27th, especially if we're the ones helping you do it. Doing those things earlier, because as we get closer to the end of the year, processing takes longer. So the earlier you start on considering what type of things do I want to donate to charity, especially if it's going to be an appreciated position or a donor advised fund, you want to give enough time to get those things going, open the accounts, make those transactions, and be sure that they get processed before the end of the year too.
Exactly.
Yeah, again, we say it a lot, but just being proactive and kind of claiming your path as opposed to just allowing that to be determined for you by the tax code or by the laws that are in place, especially for the next 4 to 5 tax seasons is really, really important. Alicia wrote a great blog about this topic as well, if you'd like to read more about that. And then also we have our market outlook that is coming up that'll come out in the first half of January. So we're very excited about that. So keep an eye out for that as well. And as always, thanks so much for tuning in to another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.